Hi guys, welcome back to my YouTube channel, and let me take this opportunity to wish you a very happy and prosperous New Year 2025. As this is the beginning of New Year, I decided I'll make one exclusive video on trading plan for year 2025. There are many changes happened last year, many rules have been changed, especially in the F&O segment. So that is why if you are a serious trader, if you are a professional trader, then you should be ready to fine tune your strategy, fine tune your system according to market structure, according to market behavior. So in this video, I'm going to discuss trading plan for option buyers, option sellers, day traders as well as swing traders. It may happen that this video could become a little bit lengthier video, but ensure that you watch the video till the end because I'm going to discuss few things which you may not be aware of it. Okay, so now let us start with the first thing. Let us see what actually trading plan is. Trading plan is nothing but having a list of rules surrounding strategies and risk management for every instrument. So one good trading plan should have different strategies for different method, that is option buying or option selling. Maybe you are an option buyer, then what is your plan for option buying? Or if you are an option seller, especially expiry date trader, then what should be your plan for trading that instrument? It could be indices, it could be stocks, it could be commodities. And the third most important is going to be risk management. And the risk management is deciding what risk reward to follow for each system and each instrument. And first one, we are going to discuss about the option buying for day traders. I'll be discussing about option selling also for option sellers, but let me first start with the option buying. For option buying, especially traders who are trading indices, I suggest look for a trend reversal. That means something like fake breakout. So my suggestion is for option buyers, for indices traders, because such opportunities can give good profit most of the time for option buys. Now let us discuss what is this method is all about. Suppose this is the instrument which is going up and then it came down and then it took the support from the previous day low. That becomes your support, and where it reversed earlier, that becomes your supply zone or a resistance. Sometimes it may happen that price may break this level and looks like breakout, and eventually instead of going up it reverses. That is called fake breakout. Okay, so whenever fake breakout happens, most of the time you can expect a violent move on the downside. That is called fake breakout. So that means people who went long here, they have a stop loss here, and once the stop loss is triggered, you can expect a huge move, and that is the best opportunity for option buyer by buying the put option when fake breakout happens. Sometimes it can happen on the downside also. That means it breaks the support and start going down, and people start taking a short trade here thinking that price will go down, and they will start buying the put option only to see that price reversing and start going up. So in that case you can go and buy a call option here. That is called fake breakout. This is the Bank Nifty chart, and where you can see the support on this chart. You can clearly see that this is the support, the red candle low, this is the 28th December low, and again to 31st December also candle took the support. So that is the strong support, which is around 50,615. So once you have identified that is the strong support, then next one is wait to see whether any fake breakout happens on this chart. So you have already marked the support, and the next day, that is 1st January, you can see that price has broken that support, right? And after that, what you can see that immediately there is a fake breakout. Fake breakout means you can see that this candle made a breakout, but immediately this candle closed above that breakout line. So that is where you can buy call option, because most of the time big move can come whenever this setup happens. Okay, so that is what I mean to say that fake breakout. It can happen on upside or downside, but important is you have to go to higher time frame like daily time frame and see where is the important support resistance, and wait patiently for that level to break, and wait patiently whether that breakout fails. If it fails, then you can get one of the best opportunity for option buying. And this fake breakout strategy we discuss in our updated 25-day trading strategy in Nifty Bank Nifty, where you can see the course detail below this video in the description section. And that's about option buying plan in indices. Now let us see about the commodities, especially for traders who trade in commodities, especially crude oil, gold and silver. For them, I can suggest about one of the very powerful strategies for commodities, that is the Asian session breakout or Asian session demand zone reversal strategy. What is this strategy? Let us look at the chart. Okay, for this strategy, I have a indicator called sessions indicator. So when I click this session indicator, it comes on my chart. You can see that on my chart, I have a blue color marked here, and here it is a green color, here it's a dark brown, and here it's a light brown, and again blue, like it's repeating. What actually this color code is? The color code is, this is the Asian hours. That means this is where Asian market traded. Green means that is where European market traded. And when there is a dark brown, that means European market and US market overlap, because US market opened around 6:30 Indian time here, and after that light brown mean it's only US market. So that is what this color code will tell you, that which market opened at what time. So Asian session is a blue color. So what you can do is you can mark this kind of levels and say if there is a breakout from the Asian session. So I marked the level here. So you can see that I marked the level, and you can see that from here breakout happened around 2:30 and again at 3:30. So that is your entry. So you should patiently watch for the breakout to happen from the Asian session, and most of the time you'll get one of the best entries in that. For that criteria is, you should see that Asian session would have traded quietly. That means Asian session there was no big move. If you see, this kind of quiet move happened, and if the breakout happens later part of the day, most of the time you can expect a big move on the upside or downside. Same like breakout, there is another strategy called demand zone strategy also. That means you can see that this is the 3rd December. You can see that it's not a quiet market, right? There was a market zigzag. Zigzag means what? That means whenever price came here, price made a bounce. So that means this is the demand zone. So whenever you see that price made a big move from that level in Asian session, what you can do is you can mark that level on your chart, and if price comes back to that low, most of the time you can expect a big move on the upside. And this strategy we discuss in more detail in our new commodities course, that is the gold and silver course. You can check the details below this video. Now we are coming to the next one, that is for option sellers, especially option seller who trades in indices like Nifty, Sensex and all this. Now you know that there have been new rules. Earlier it was everyday expiry, now it is 2 days expiry. That is Tuesday and Thursday only. Earlier it was Monday to Friday. So how you can take the advantage of 2 days expiry? For them my suggestion is you can trade in Sensex on Monday and Tuesday. Tuesday is going to be the weekly expiry in Sensex. Then you can trade on Monday also. That is 1 day to expiry. Why 1 day to expiry? Also one of the best way to trade for expiry traders, because as an expiry date trader or option seller, what you want? You want two things. One is theta decay, another one is high premium, right? On expiry day, that is 0 day to expiry, you will get good theta decay, but premium will not be good, right? So how you can balance it? So you can balance it by trading 1 day to expiry. That means 1 day prior to the expiry day, because premium will be very good 1 day prior to expiry day, and theta decay also will be there, not as much as expiry day theta decay, but still you will get some theta decay. Okay, so Sensex you can trade on Monday and Tuesday, and Nifty you can trade on Wednesday and Thursday. That is 0 day to expiry and 1 day to expiry. So I suggest trade with credit spread for 1 day to expiry. Why I am saying that? That also I show you with the chart. Okay, when you are trading on 0 day to expiry, I suggest trade naked option selling with stop loss. Okay, this is the chart of Nifty daily time frame chart. Okay, I said you should focus on support resistance even though you are trading credit spread. First you have to do the analysis of price action. So you can see that last candle what you see here is 31st December, which is Tuesday. So when is the Nifty expiry? Nifty expiry on Thursday. What is 1 day to expiry? 1 day to expiry on Wednesday. So that means Tuesday you already know that candle closed. Tuesday is over. Wednesday morning before market opens, you are waiting for market to open. Before that, for credit spread also, it is based on direction. Which way you think that Nifty will go based on this chart? What do you think that from here Nifty likely to go up, or you think that Nifty likely to go down? What's your analysis? If anybody knows basic price action, they will say that their analysis is Nifty to go up. What is the reason? And the reason is very simple. That means which is a strong support. This is the strong support, right, which was again supported by this 31st December candle. So that means we have a strong support around 23,542. Where is the next resistance? Next strong resistance is this candle high. So we have next resistance around 24,060, right? So what is the high chances of price to go from here? So chances of price to go till here in coming days, right? Rather than going down, going up is higher because already this candle took the support. So you expect Nifty to go up on expiry day or 1 day to expiry. Now what you can do is you can go for a software called StockMark. StockMark is one of the best software where you can do the analysis or you can build the strategy. So here I have kept the simulator for which day is that 1 day to expiry, which we are going to do the analysis 1st January, 1 day to expiry, right? So let us change here simulator to 1 day to expiry, and 9:16 I put it, 1 minute after the market opens. What is our analysis? Our analysis is bullish, right? We expect Nifty to go up. So what we have to go for? We have to go for a bull put spread, not the bull call spread. Bull call spread is a debit spread. Better to go for a bull put spread because it has a higher win rate. So when we go to the bull put spread, this software immediately gives the which option to go for. It says that 23,650 put option sell and buy 23,450 put option. But the problem is if you go and trade as per this software, then your risk reward will not be good. Look at this. Risk reward is 1.821, right? In credit spread, you should go for at least 1:1 risk reward. So what you can do is you can adjust the strike price so that your risk reward gets better. How you can do it? Reduce the difference between the both the strike. Now you have to reduce the difference between the both the strike, but still you can see that risk reward is 1.321. So let us increase it little bit, and now you can see that risk reward is 1:1, right? Now we have 1:1 risk reward. Now we have break even at 23,673. Currently spot is trading 23,649. That means if it goes by another 25 points, then we comes to the break even. After that, if Nifty start going up, then we'll achieve this maximum profit potential. I am talking about one lots, okay? If you are trading with more lots, then obviously profit and loss both will be bigger. Now what happens on expiry day? Expiry day is 2nd of January, right? If you go for a bull put spread, you can see that now risk reward has gone bigger, right? 2.121. Risk is bigger than your reward, right? Maximum loss is bigger than your maximum profit. Even though you try to adjust it by getting it closer, what happens, your break even goes higher. If you keep higher break even, then chance of hitting that break even becomes very less, right? So that is why I don't suggest credit spread on expiry day. Better to go for naked option selling with stop loss. Let me show you that example also. Now for that, let me give you this Sensex example. You can see that when is Sensex expiry, 3rd January, it was on Friday, right? So this was a strong support. Now that strong support will become resistance. Why? Same simple price action logic. Support becomes resistance, resistance becomes support. So this 80,070 will be strong resistance. So what is your analysis now? What do you think that when market opens, do you think that market will go from here on the upside, or you think that market will come here from the downside? What do you think that? What's your analysis on Sensex? Are you bullish or bearish? Your analysis should be bearish because now it is coming near the resistance, right? So that is how you have to do the analysis, and accordingly you should trade. So now let us replay the button, and you can see that next day what happened. Exactly, price reversed from that level where we marked the black line. So it was a bearish day. So now let us go to option chart. 80,100 was nearest strike, 3rd January expiry day. I'm going to show you that why it is better to sell option at the opening rather than selling late on expiry day. So if you sold option here at the opening, you would have got around 240, 235, something like that. But if you waited for 5 minutes to close, then you would have got at 175 or 180, right? Already you lost how much? Almost 40-45 points you lost because you waited for 5 minutes candle to close, right? Had you entered right at the opening, then you would have got very premium. So that is what I want to say, that if you want to become an option seller on expiry day, and if you want to get very good premium, then you will get very good premium only at the opening minute. That means first minute only you will get very good premium to sell. If you wait, then you can see that 175, it became 125, right? Within one and a half hour, it came to now 20-25 rupees. If you sold at the opening, you would have got 220, 225. As an option seller, you need very good premium to sell option, right? There is a method how to keep stop loss, everything, because some people may be thinking that if I sell here at 230, 240, and if it start going up, my stop loss will hit, right? Every time it will not go down like this. Yes. Why we have taken a short trade here? Why we have to take a short trade here? Because it is at the resistance. We have seen on the daily time frame chart, on the spot chart, it was resistance. That's why we have to sell call option, right? That's about trading plan for option sellers. Let me summarize. If you want to trade 1 day to expiry, better to go for credit spread, but ensure that at least you trade with 1:1 risk reward. But when you are trading on expiry day, try to sell the option at the opening minute of the day. Ensure that if the opening of that day opened right at the support or resistance, okay, then only this can give high probability trades. Okay, we already discussed about day traders. Now what about the swing traders? So swing traders, how to take the trade? For swing traders, especially trader who want to trade in commodities, for them you can mark order blocks on 1 hour time frame chart to look for zone where big players accumulated or distributed, and wait for price to retest those zones for high probability entry. Let me show you that also on the whiteboard. Okay, order block mean on 1 hour time frame, you see that sometimes price is trading very quietly without much movement, and then series of big green candle and it starts going up. So this is known as order blocks. Okay, this is known as your order blocks. If for some reason price again retest that order block, then chance of price going up is higher. So why order block is very important, especially when you're trading commodities. Remember, this is only for commodities. Why? Because commodities is 23 hours market. Okay, it's not applicable for Nifty Bank Nifty. Especially it is applicable for gold, silver, crude oil and all these kind of commodities. Why it is not applicable for Nifty Bank Nifty? Because Nifty Bank Nifty is not a 23 hours market. That's why you see that most of the time gap ups, gap downs common. But commodities gap up, gap downs are very less. So that is why this setup can work only in commodities most of the time. Okay, so that is what the order block is. It can be either side. It can be sometimes trading like this and suddenly price starts going down and this becomes your order block. The level where price started going down. Okay, when price comes back to that same zone, that becomes your order block. Okay, let me show you the chart. This is the gold chart. You can see on the chart that some levels price was trading very quietly and then series of big candle, right? Price was trading very quietly for some time, then there is a big move came here, right? So when you see this kind of price action, that becomes your order block. So that means order block means big players quietly accumulating or distributing. Okay, so you can see that this becomes your order block because of big move. Next time when price comes here and takes support around that level, that is one of the high probability entry for swing traders. Again, you can see that here price was trading very quietly and then big move came, and when price came back to that level, that becomes your high entry for taking a long trade. So here also you can see that price was trading very quietly here, then couple of bullish green candle, and when price comes to that level, that becomes your entry for taking a long trade, right? Here also you can see that trading with a small candles and suddenly big move came. So if price retest that level, that becomes your entry point. Okay, so that is one of the strategy which I discuss in my new course, that is the gold and silver course. In that course I discussed this strategy. Here also you can see that same example, it was small candles then made a bullish candle, so that becomes your order block. So that means when price comes to that level, chances of bounce from that level becomes very high. Okay, next one, let us discuss now for traders who are a swing trader in stocks. For them, my plan would be trade with the support and resistance on higher time frame, but same time you can also refer time cycle. So what is the time cycle is all about? Time cycle is a method of trading where it will tell you that historically what happened with that stocks on that specific days of the month or specific days of the year. I already made a couple of video on time cycle. You can watch that video if you want to understand more, and that is what time cycle will tell you, that whether during that period that stock stayed bullish or bearish. Okay, let me show you a couple of example now. So this is my back tested report long-term annual cycle data. Here you can see that Coal India is showing that from 12th November to 22nd November historically, that means if you go to the last 10 years, 15 years, and if you do back testing, it says that 12 to 22nd November, most of the time Coal India stock stayed bearish. Anyway, we can't recheck it on last 10-15 years. So what we'll do is we'll check only last year, that is 2024. Okay, this is the Coal India. So we have seen that historically from 12th November to 22nd November it stayed bearish. So this is the 12th November opening of this candle, and where is the 22nd November closing. So you can see that 12th November to 22nd November, as per the time cycle, yes, Coal India stayed bearish in year 2024. Now let us see another example. Another example is Divis Lab. Divis Lab is saying that 17th to 27th November, Divis Lab stayed bullish on last few years. So let us see that also on the chart. So this is the Divis Lab chart. So 17th November was Sunday. So we'll take 18th November because 17th November was Sunday. This is the 18th November opening, and where is the 27th November? 27th November was here. So this is the close of 27th November. So you can see that as per the time cycle, yes, Divis Lab stayed bullish from 17th November to 27th November. But remember, time cycle is not a 100% foolproof method. Time cycle can give you that edge because you know that historically what happened with that stock. But along with time cycle, you should also follow price action like support and resistance, and time cycle you can keep it as a reference. And finally we are coming to the last one, that is risk management. Okay, so risk management is very important as strategies. So already I discussed that when you want to trade in credit spread, at least look for minimum 1:1 credit spread. If you see that risk reward is not even 1:1, then don't trade in credit spread, because it all comes to the risk reward in trading. So when you are trading option selling, then also look for 1:1 minimum. That is what I said. If you try to sell option premium at the opening minute, first minute of the day, then you will get very good premium. Suppose if you get the premium at 50 rupees in Nifty at the opening, 50 rupees, then you can keep stop loss at 100. Whatever the premium, exactly double of that as a stop loss. So what is the difference between 50 to 100? That is 50 points, right? So that means what is the risk reward? 1:1 risk reward. After that, you can lower your stop loss if you see that price is going in your direction, and you can make 1:1 to 1:2. That is the beauty of selling option on expiry day. When you are trading option buying, then I suggest that for intraday at least keep 1:2, because win rate is in option buying not as high as option selling. That is why at least keep 1:2 as risk reward in option buying. And if you are a swing trader, then at least 1:2 or 1:3 or even more you can keep risk reward, because in swing trading you hold your position for a long time, right? Why risk management, risk reward is so important? Because of this. You can see that if you are trading with 1:1 risk reward, your break even come only at 50%. So once it goes beyond 50%, then your profit starts. But same time, if you are trading with 1:2 risk reward, once it touches 40%, after that your profit starts, right? So that means the more you keep the risk reward, you can have a lesser winning probability. You can see here, if somebody trade with 1:5 risk reward, you can see that even 20% win rate also enough to become a profitable trader. So that means the more you keep the risk reward, you can have a lesser winning probability, still you can be a profitable. So that is why when you are trading, you should see that which method have a high winning rate. Option selling have a high winning rate. So you can trade with 1:1 risk reward. If you are going for option buying, or if you are a swing trader, then at least 1:2 or 1:3 minimum, because option buying doesn't have same kind of win rate like option selling. And finally, remember, only thing which can keep you in the game of trading is risk reward ratio. Okay, how good is your risk reward ratio? That matters in trading. So that's about this trading plan for year 2025. If you want to learn more about strategies, more about price action, then you can go below this video in the description section, and you can check out my all the courses for all type of instrument. So that's it guys, and I'll see you soon with a new video. Until then, bye and take care.